So hello everyone. Thank you for joining in today's call on Saturday morning. We are doing this session on a very interesting topic, that is Gift City. Everyone is talking about it, but we will go into the nuances of Gift City. And we have with us Mr. Mihir Shirgaonkar. He is head of alternative investments at Phillip Ventures, and he manages their global PMS and investment advisory business at Phillip Ventures IFSC, domiciled in Gift City, Gujarat. He has more than 8 years of experience in asset management industry. He is a chartered accountant and CFA charter holder, and he has done his MBA from IIM Ahmedabad. Previously, he has worked with DSP Investment Managers and HDFC AMC in his previous roles. So thank you, Mihir, for joining in today's call and addressing our audience.
Thank you. Thank you so much, Aditya, and a very good morning to all of you. Thank you so much for joining us on a Saturday morning. I think after a busy week, you taking us time for all of us is, I think, really means a lot. So once again, thank you so much, and really excited to share our thoughts on Gift City and the global markets and what we really see going forward. Yeah.
Right. So I'll start with a very basic question. What is Gift City? Can you help us understand more about this particular term?
Sure. So Gift City, of course, everyone has been hearing about it. Everyone has been reading about it. People are becoming more and more aware. But just to give you, a wider context with, what was the objective of Gift City. So Gift City, by design is India's first integrated smart city. And it is envisaged to be India's gateway to the global markets. So it is actually India's own offshore jurisdiction. So when it assumes the status of an offshore jurisdiction, it typically means that it is a location which is territorially within India, but for all exchange control purposes, it is considered to be a region which is outside India. And this status alone gives Gift City a completely different set of implications when it comes to banking, when it comes to the markets, and all the other financial services that are coming in. So as I mentioned, Gift City is India's gateway to the global markets, and it is envisaged for two things primarily. One is a lot of non-resident Indians and foreign nationals can better access the Indian capital markets through the kind of products that are coming in Gift City. And secondly, the route which we began our journey with is typically enabling resident Indians as well as, let's say, other investors to invest in the global markets. So we have our own businesses in Gift City, and like firms are coming up which are setting up their own investment desks in Gift City and offering investment products which enables investors to invest globally. So that is the second objective. So both ways it is functioning. Typically India's gateway as it is rightly envisaged and being executed as well. Yes, Aditya.
Right. And as you rightly said, it works both ways for the resident Indians to invest into global products and non-residents to invest into Indian capital markets.
That's correct. So in fact, there is a third category as well, which invariably we only have, perhaps introduced. And it is non-residents investing into the global markets, again, by using Gift City. And this itself, is very unique because let's say any investor sitting in Dubai or a Middle East, Singapore, Hong Kong, this investor will have his or her own avenues to invest globally, but still they come to Gift City. So it only speaks about the kind of credibility which now Gift City is slowly and steadily enjoying in the minds of investors. Because Gift City, by design, and just to add on to this, is managed by a completely different regulator, the IFSCA, which is the International Financial Services Centers Authority. So this is a regulator which functions completely distinct from SEBI and RBI jurisdiction, and it functions as a unified authority, like a unified regulator. So all capital market as well as financial services businesses within Gift City are governed by this regulator. And again, it is the endeavor of the regulator to have a lot of globally benchmarked best practices. And that is, one of the key reasons why increasingly there is a lot of awareness and a lot of interest for global investors, to explore the gift city route.
Right, right. And when it comes to NRIs, particularly investing into Indian products,
Right.
they have a lot of operational hassles in opening an NRE, NRO account,
Correct.
and transferring the money. So, how
Right.
does the investing process works for an NRI? Is there a new bank account that's opened under IFSC for them, and how does the operational
Right.
work out for the NRIs?
Correct. Now, it would, really depend on the kind of product. So if it is a PMS structure investing into the Indian markets, so then but they may not be required to open a bank account, but again, the demat account and those processes are similar. But if you look at some of the fund-based structures, so a lot of AIF structures coming in Gift City, AIFs which are investing into the Indian markets, the biggest value proposition for non-residents and foreign nationals is that they are not required to open any separate bank account in Gift City. And as Aditya, you very rightly mentioned that all the processes around NRO and NRE, typically coming under the PIS route of RBI.
Right.
If let's say such investors are to access Indian products directly, maybe a PMS, an AIF, or a mutual fund, so they are required to undergo significant amount of paperwork. But here, if they are coming through the gift city route, they are not required to open any bank account. Of course, the other processes of KYC, the verification, the background check, everything remains the same. Definitely, that stays. But the very fact that they don't have to open a bank account separately, they can quite literally invest, directly using their dollar to dollar account, because in Gift City, largely the unit of currency is the US dollar. So they can directly make a dollar to dollar remittance, and that is how the fund manager then takes it forward and then can make the investments. And investors in this AIF kind of a product will get issued units as well. So that is significantly reduces the operational hassles.
Uh, right, right, right. And now coming back to the resident Indians who are investing there into global products,
Yeah,
they come under LRS scheme, whatever money that they transfer.
that's correct. Yes.
And how does it work out in case of Gift City? And how is the global PMS offered in Gift City different from, say, an India-based mutual fund that is offering overseas exposure?
Right. So it differs on two counts, I would say. First is, I'll address the banking bit first.
Mhm.
So, as you said, that because Gift City is an offshore jurisdiction, so any money which is remitted to Gift City, transferred to Gift City, is considered to be money which is remitted outside India, if a resident Indian is doing it. And for that, the investor will come under the LRS. So while the investor doesn't have to open a bank account, but that procedure of the Form A2, which the investor would have any which ways filled for any other foreign payment, that comes into picture. As
Right.
compared to that, if you look at a mutual fund offering a global product, Indian, like resident Indian mutual fund offering a global investment, so these LRS implications don't apply. The larger challenge, of course, however, could be that under LRS, the investor can remit a maximum of 250,000 US dollars in one financial year per PAN number. Now, the investor can obviously remit more amount in equivalent rupees to an India-based mutual fund, but mutual funds have their own industry-wide caps, and those are implemented by the RBI. And you do have cases where such mutual funds stop accepting payments from investors. But that is definitely not the case for Gift City. So that is one aspect of it. The second primary difference comes around taxation. Now, in last year's budget, with the entire concept of specified mutual funds, so all debt mutual funds, commodity-based mutual funds, or even the foreign feeder funds, the
Right.
entire income of that scheme, like whenever the investor is redeeming units, is taxed as a short-term capital gain, and that makes this product, some bit less attractive. But if you look at a global PMS, such as ourselves, so because these are discretionary managed accounts and it is a PMS after all, so the investor is actually holding those individual global securities. So there is security level taxation. And because these are directly overseas securities, the normal capital gains taxation should apply, is the guidance that we have from our consultant. So here, whenever the portfolio is getting churned, the investors will face the incidence of taxation. So here, the long-term capital gains will be taxed at 20%, and with the benefit of indexation. Short-term capital gains will be at the regular rate of taxation. So this is one point which investors can take note of, because even if, let's say, in case of our mutual funds, we are investing in global equity-based instruments. So that doesn't mean that the equity taxation in India applies. The normal capital gains taxation applies. I hope this answers.
Right. Taxation, none that makes a huge difference
Right.
When you are significantly building exposure in
Correct.
global products.
Right.
And so for domestic PMS, we understand that there is a minimum ticket size of 50 lakhs that is set by SEBI.
50 lakhs, yes.
What is the minimum ticket size, or what is the usual ticket size that is there in the gift city
Right.
PMS?
So according to the IFSCF fund management regulations, and I quote these regulations because we are a registered fund management entity in Gift City, under which license we are offering the global PMS. The minimum ticket size is 1,50,000 US dollars. So that roughly translates to 1.20 crore rupees for the investor.
Right.
The other thing which investors may want to take note of is that there is a 20% TCS as well, which the investors will have to pay over and above it. I know it comes across as, let's say a shocker for some investors, because for a 1,50,000 US dollar investment, the investor may have to actually arrange for 1,80,000 US dollars, because they will have to pay that TCS over and above. Of course, TCS does become more like a cash flow management issue. It is substantial nonetheless, so no denying here. But definitely, at least if it is an let's say an HNI investor who, any which ways, could be paying substantial sums in a self-assessment tax later on, they can always use the credit of this TCS to pay a lesser tax, at the time of income tax return filing. So that is, about the ticket size. But now the same regulations also say that if the investor is an accredited investor, then the minimum ticket size need not apply. So in which case, if the investor fulfills the criteria for accredited investors, they can actually invest with an amount lesser than 1,50,000 US dollars also. Just about a couple of weeks back, slightly more actually, the guidelines for accredited investor are finally out. And, as I'm speaking to you today, our compliance team is already working on an internal policy to, implement the accredited investor piece. So that should, because 1,50,000 US dollars, at least for some investors, could be a substantial sum. Also, given the fact that there is an upper cap of 2,50,000 US dollars. But now I think we are definitely getting a renewed interest, especially because of the way the world markets really were last year. So, again, we've received a lot of interest, and we are seeing those kind of flows as well in our PMS.
Sure. And now moving from regulatory and operational sector, how do you see? Let's talk about international diversification, because in India, particularly in mutual fund sector, there are not many products that offer international diversification.
Right.
And how does allocation in a global product and global equity help in the overall portfolio of the client?
Sure. I think a very relevant question, actually, because today, as we keep on discussing also, that there is definitely a lot of awareness among Indian investors also. Indian investors of today are much more knowledge driven. They are much more updated with the global events. Sitting here in India, they would be very up to date about some of the policies of the US Federal Reserve, for example. So, definitely there is an awareness, but then, the journey from that awareness to actually making a case for global investing, we would, essentially address this on three parameters. First is when you actually look at the way the global markets have really returned in the previous decade. Now, if you look at the returns a bit of some of the largest equity benchmarks globally, if you see, we can find that during the period 2000 to 2020, I mean that entire 2010 to 2020, I'm sorry, in this entire decade, it is actually the US markets that did considerably better than some of the, in fact, all the other benchmarks. If you really look in terms of the CAGR terms. So yes, Nifty was also one of the best performing benchmarks. Even Nifty did give you a double digit CAGR during that period, but the returns from, let's say, the S&P 500 were comparable. And Nasdaq, definitely the returns were far higher on a CAGR basis. That's number one. Now, what is missing in point number one is the fact that these returns that I'm talking about are the local currency returns. If you actually factor in the impact of rupee depreciation, if we really have to think in terms of how much an Indian investor investing Indian rupees in an S&P 500 would have made, so the Indian investor would have actually made returns on two counts. One is the underlying return of the S&P 500, and second is the depreciation of the Indian rupee. So if you actually convert the dollar returns into rupee returns and then compare it with Nifty 50, you would have found that in the previous decade, the case for a global investing is even stronger. So that is the second advantage. So first advantage, of course, is I mean, as I mentioned, that while India is one of the best performing economies, as a global fund manager, I really cannot shy away from the fact that India is expected to be one of the fastest growing economies. In fact, by 2028, it is said that India's GDP growth will surpass that of that of China, and in terms of percentage growth, India is expected to grow much faster than the US, China, and all these other nations as well.
Correct.
But what the previous decade did prove to us is that a faster growing economy need not necessarily mean a better performing equity market. So while the core allocation for an investor can remain Indian equities or the Indian securities, you should also be cognizant of the fact that there are pockets of opportunities in other parts of the world as well, which through the right set of let's say investment products, investors can actually factor in and capture those returns in their portfolio as well. Second is, of course, as I mentioned, the depreciation of the Indian rupee. Now, just like any other asset class, even the rupee will have its own cycles of ups and downs. Now, since 2022, the Indian rupee witnessed a very sharp depreciation relative to the US dollar. Will we actually see the same kind of depreciation, in the coming years as well? So my personal expectation is that yes, you could expect a modest depreciation when we look in a CAGR terms. But on an average, 1.5 to 2.5% on an average is the kind of depreciation which is which can be considered reasonable. But now coming to the third and perhaps the most important value proposition for a global portfolio. Now, if we really look at the markets around us, and especially if we now step into the current decade, because whatever I have mentioned so far is things that have already happened, and obviously the question for all of us could be what next. So when we actually look in the current decade, what we realize is that there are a lot of global trends, happening in markets around us, and I'll just list down some of those trends. So the first trend is what we call as a grand reset. Now, if you look at the entire COVID-19 pandemic and the disruptions that it really brought about across businesses, across regions, across supply chains, what has really happened is that businesses across the globe have started to rethink their business models. And, there is in some sense, there is the sense of deglobalization that we can see. I had even written about it as part of one of my articles for the CFA Institute. You can check it on the newsletter as well. So there is, one deglobalization because of which a lot of other economies outside of, let's say, China can actually, see some opportunities. That is number one. Second is the kind of disruptions that we've already seen in businesses starting with the previous decade. Because in the previous decade also, when I spoke about these returns, if we really look at the returns of NASDAQ, they have actually been very strong starting from the second half of the previous decade. And what these strong returns of NASDAQ really suggest to us, or the insight that we conclude from this is that in the previous decade as well as the current ones, the markets have actually rewarded those countries, those companies, and those businesses which are actually at the forefront of technology disruptions and innovations. Today, when we are talking about the magnificent seven companies in the US, okay, the Apples, Amazons, and the other companies. So there is, increasingly there is a wider adoption of artificial intelligence. Artificial intelligence, which is, actually bringing out a lot of efficiencies in the way businesses are being carried out globally. There is significant cost reduction on certain counts, and because of which the profits of a lot of companies is actually improving. Now, our opinion is that these benefits of AI will actually flow to those companies or those, let's say, regions which are the early adopters of this technology. So, will India catch up? The answer is yes, definitely. But a wide scale adoption of some of these Industry 4.0 technologies could be a decade away. Now, I have gone on record in saying that India has some of the brightest scientific minds in the world today. But in terms of infrastructure, it is getting built up. I think we've got the right policies in place. We've got the right infrastructure plans in place. So definitely that infrastructure is coming up. But currently, if we see, if you look at the developed part of the world, so they are already early adopters of these technologies. And we are really talking about concepts like semiconductors, there is artificial intelligence, let's say a lot of awareness around ESG, or we could talk about electric vehicles or robotics and a lot of other investment themes, as we would like to call them. Now, these are ideas which we believe will drive the next leg of global growth. But we also believe that these are ideas which may or may not be accessible if you are looking at only the listed Indian equity space. And this alone is the largest value proposition that that we are offering through our products to give investors an opportunity to capture growth stories across innovations as well as regional developments, and to allocate to what we call as the trends of today as well as the ideas of tomorrow. So this makes the case for a global portfolio very, very strong.
Absolutely, absolutely. And so coming back to your portfolio, could you
Right.
throw some light on the geographies where you are allocating and on the sectors where you've already touched upon the sectors, but if you
Correct.
can just throw some more light on specific weights on the sectors and the geographies
Surely,
and
yeah.
your investment philosophy.
Surely, surely. So the name of the portfolio, the name of our portfolio is very apt. The global PMS strategy that we are offering is the Phillip International Pioneer Portfolio. And why do I say that the name is very apt? Because we have effectively pioneered global investing through GiftCity. We are the first operational fund in GiftCity who is offering a global PMS. And this is a portfolio where we are investing, across regions and businesses. The entire idea or the entire investment objective of our portfolio is to generate capital appreciation by investing into various geographies, sectors, and businesses which we believe will grow over the medium to long term. And so that is, our idea. While we are talking about innovations and the forward-looking industries, we started the fund in 2022, that to the early part of 2022. So we were very, very cognizant of the kind of volatility that could be ahead of us because of the way interest rates were set to rise and the way inflation was spiraling out of control. So when we are talking about investing in these innovations or let's say ideas of tomorrow, that does not necessarily mean that this is a technology heavy portfolio. Yes, there is substantial investment into technology. If I have to speak about the top sectors in our portfolio, so it is technology, there is healthcare, and then there is financials. And then we've got a lot of, other investment themes which are categorized as thematic. So now if I really have to list down some of the businesses that we've invested in, through our securities. So we've invested in areas such as semiconductors, cloud computing. There is medical devices that we've invested in. We've invested in uranium also. So we actually have investment products that are actually giving us exposure to something like uranium. In fact, if I have to take a step back, I can tell you that ours is a portfolio which is investing in ETFs. We are not directly investing in stocks or bonds, but we are investing in ETFs. As let's say investors, people may have this one very obvious question, that why are you investing in ETFs? When you can directly invest in stocks and bonds. Or even if we have to take another step back here, whenever we say ETFs, the first thing that could come to investors' mind could be a Sensex ETF, a Nifty ETF, or maybe a Bank Nifty ETF. So investors could definitely wonder that if the fund manager is indeed investing in global exposures only or the broader market exposures, why would you allocate to a fund manager? What is the true value addition? So this is where our investment philosophy comes into picture. So first is if I mean I'll now delve into a very detailed discussion on our investment philosophy. First is when we actually talk about the universe of ETFs in the US markets, because we are doing only US listed ETFs. What we find is that the investments are available not only at a broader market level, but at a sector level. And then even within sectors, we have ETFs available on individual businesses and individual investment themes. So what I mean by that is I'll just give you an example. Now, if you look at a sector like healthcare in the US, so like similar to technology, even healthcare in the US is very vast. And within healthcare, you have businesses such as medical devices, biotechnology, there is genomic revolution, there is pharmaceuticals, there is digital wellness, for example. Now, these are five different businesses within healthcare, and each of these businesses have different risk and reward characteristics. A very generic how do I say, trend in healthcare need not necessarily affect each of these businesses in the exact same fashion. Now, I just gave you an example of healthcare, but there are such investments or such businesses across these 11 sectors in the US, and you have ETFs giving you specific exposures only to these businesses. So you have ETFs giving you exposure only to semiconductors, or only to medical devices, or only to cloud computing. So what we are actually doing as part of our portfolio allocation is we are making a very conscious selection of some of the best performing businesses which we believe will grow over the medium to long term. So that's one element of the portfolio. The second element is a regional exposure. Now today the market for US listed ETFs alone gives you access to more than 50 to 60 different regions globally. Even in our in our portfolio, or as part of our research, we are monitoring more than 35 different countries. So and each of these investable using only US listed ETFs. So I mean, if I have to invest in a Taiwan, for example, I will not go in the Taiwan stock exchange and then grapple with currencies. We will simply buy the US dollar denominated Taiwan focused ETF, which is trading on the American exchanges. So what we've actually done at our end as part of our backtesting and initial research is that we've individually studied the sector focused funds in the US and curated a list of more than 70 different investable businesses using only ETFs. You have all sorts of businesses. You have some suddenly gold miners, copper miners, energy transition materials, etc., etc. And this is a list which is very internal and specific only to Phillip Capital. It is not a list that you will actually find on the public domain. So we've actually curated this list in-house. That's number one. And second is, of course, some of these countries that I told you that, more than 35 countries are under our watch. We are constantly monitoring, events in these countries and how these events and how these developments are actually translating into the equity returns from these countries. So that is something that we monitor. Which may still bring us to another question that today, there is so much awareness even around ETFs. If any of the investors were to open their own trading account, let's say, they can have access to all these ETFs. they might as well pick and choose ETFs on their own. Why do they still need a fund manager? Is the question that you may have. So here, I can tell you is that if you really look at the US markets, only in the years 2020, 2021, 2022, as well as 2023. In each of these 4 years, there have been more than 400 new ETF launches every single year. So just imagine if a year is consisting of 250 or 260 trading sessions in a year, on an average, every single day in each of these 4 years, the investor will have more than one new ETF on an average to invest in. Or at least that is the kind of choice available. And then there is so much information overload. Suddenly there are Bitcoin ETFs coming up. Suddenly there are video gaming ETFs coming up. You have ETFs on, something like pet care and other areas as well. There could be merit in these businesses. We are not really denying them, but investors at times do get so much spoiled for choice that they may either end up dipping their feet everywhere, only to realize that the portfolio is very large and the investment allocation is very, very suboptimal. Or they may be, so much overloaded with information that they may not be able to decide. So this entire journey of more than 4,000 US listed ETFs to that final 15 to 20 ETFs that form our investment portfolios is the result of our investment philosophy. It is the result of a very, very rigorous risk management process where we are looking at not only quantitative filters but even qualitative assessments. And the pillars of our investment philosophy are as follows. So our investment philosophy rests on four very strong pillars. First is a very, very strong focus on fundamental research. Now, we are Phillip Ventures IFSC. We are domiciled in Gift City. So we are a part of the India business of Phillip Capital. If anyone would have had an opportunity to read the research reports that come from Phillip Capital India, you could acknowledge that these are some of the best pieces of investment literature available on the market today. And the testimony to this fact is that our analysts, our sector specialists are rated anywhere between number 3 to number 1 in their respective field. Now, this is about Phillip Capital India, but Phillip Capital largely, is a global firm. We are domiciled in more than 15 countries globally. And a focus on fundamental research is a concept which is actually stressed on across regions. So that is the kind of responsibility which even we have shouldered at our end. So our entire idea is to really deep dive into various asset classes, businesses, and regions. And I'm talking about the investment desk in Gift City to identify investment opportunities. So that is a very strong focus on fundamental research. That's our first pillar. Second is a lot of data-driven capabilities or a quant-based approach, as we would like to call it. Now, because by design, our portfolio is a top-down approach portfolio because we are picking and choosing ETFs. So, macro level indicators and macro level happenings are of utmost critical importance to us. So, what we've actually done as part of the fundamental research is that since the past so many months, we have actually built a lot of in-house data-driven capabilities. Now, I'm a chartered accountant myself, but I have always enjoyed coding. It initially started off as a hobby, but now my team and I actually have written a lot of codes to analyze, huge data sets across different geographies, across different businesses, across different regions. Our entire focus is to analyze financial as well as non-financial data. What the argument that we have is that such data-driven approaches is what enables us to eliminate a lot of noise that otherwise happens around us. Especially in the context of global markets where there is so much information available. So we require a process, a framework that enables us to eliminate noise. That's number one. It really adds a lot of objectivity to our investment process. We are exploring, we've also started employing machine learning techniques as part of our investment research. So, those are the things that we are constantly, innovating new things in-house in order to be able to churn out huge amounts of data and then see, where we can actually observe some trends and insights from different sectors. So, that is the second objective. Of course, I can also add by saying this is that with so much discussion around technology and the quant-based approach, the one thing that we are very clear on is that we will never use a technology to tell us what to buy and what to sell. So our systems never give us the trading signals, or our systems will never give us which security we should buy or we should sell. That is a decision that is taken by the fund manager, which is, of course, me as well as the investment team. But what this technology and quant-based approaches are really helping us is to get all the pieces on the chessboard, as we would like to call it. So that's the second pillar. Third pillar is a long-term approach. So the entire investment strategy for our global PMS is that we would really like to focus on generating wealth over a very long period of time. The entire idea is to invest in some of these high conviction ideas which we believe will grow over the medium to long term. To that extent, in our investment portfolios, we do not undertake a lot of frequent portfolio churning because number one, there is tax implication also. Uh, Nothing really stops us from exiting a particular theme the moment we've entered into it. Of course, everyone can make mistakes and everyone should have an opportunity for course correction. But our entire idea is that we will exit a particular theme only and only when our fundamental thesis around that particular investment business or region, as the case may be, is getting significantly altered because of a particular event or a particular regulation or any other happening that is there. And the last pillar, of course, is seamless implementation. Seamless implementation, of course, I did speak about the data driven capabilities that we have, but it is also extended to the entire investment experience to the investor. The account opening processes are very, very straightforward. I did mention to you that the investors don't have to open any bank account in Gift City. So, that really helps them, especially the NRI investors are, very, very satisfied with our services. Plus, we also believe in keeping our investors regularly updated. So, as part of our work, you can find us on LinkedIn as well. As part of our work, every month we come out with a monthly newsletter where we deep dive into a particular theme or a particular business, which otherwise is not investable in India. And every week, every Monday morning, we come out with a weekly note. It is again, an attempt to a data-driven attempt to address some of the events in the markets, and we present our thoughts on, how these events are. So we keep our investors updated about our investment philosophy as well, because that gives our investors, number one, some insights on what is happening globally. Because today, I would like to believe that investors would be much more updated about the Indian markets, than the global markets. So at least, some knowledge gap is something that we would address. We very humbly attempt to address. And it also gives investors an insight into how the fund management team is essentially thinking, because because in every note we are giving a view, and it also reflects in the way we've really positioned our portfolios. So these are the four pillars of our process, and that is what really enables us to quite literally navigate the complex landscape of global markets and serve our investors in their best interests. Yeah.
Right, absolutely. And that makes a lot of sense. And even we as wealth managers, there are so many products that are available in the market. And currently there are more than 4,000 mutual fund schemes.
Absolutely, yes.
So we also collect the data and then present to fund managers, and then it helps us to build the different portfolios for our different clients. And it's an
Absolutely.
enabler, and then we have to, as you rightly said, it cannot be the decision maker. It is the
Absolutely,
enabler,
absolutely.
where the final decision is also based on the qualitative aspect where you analyze the investment thesis and whether you can relate with the investment thesis of the fund manager.
Right,
That
right, right.
also plays a lot of role. So there is, and thank you so much for explaining the your product and your investment philosophy in so much detail.
Right.
Here's one question from the audience.
Yeah,
Um, how do you, and you have already touched upon that. How do you see the difference in dollar returns and the returns in INR?
correct.
And how does that? How do you relate the rupee depreciation with the interest rate differential in both the markets? And currently, we have seen that US yield had also gone up. The
Right,
interest
right.
rate differential was not very high. The
Correct,
US
correct.
USD yield was also looking very attractive. So, how do you relate the difference in returns with the difference in the interest rate yield of both the countries?
Correct. So, I mean, one school of thought here is that the interest rate differential, and essentially moving on the lines of what they call as the REER, which is the real effective interest rate differential. So there, Indian interest rates are higher. US, as you've rightly pointed out that right now that differential could have been lower because the US interest rates have also, kind of shot up. But over a longer period of time, the longer this differential stays, okay, you can expect, of course, I'll not call it a steady depreciation. A steady depreciation only gets proven after so many years when you actually do a CAGR kind of returns.
Right.
Our view, in fact, we tell our investors also that while USD fixed income is looking very attractive right now, if it is for the dollar interest rate, the 5% yield, the answer is yes. But definitely, there is some merit in investing in the shorter end of the yield curve, and there is demand for such products as well. But in the next 1 to 2 years, expecting a depreciation in the Indian rupee is something which we would advise investors again, because the moment there are these rate cuts in the US markets now, currently the rate cuts are only getting shifted. That is again a different discussion, because we've always been of the view that because of the elevated prices, the rate cuts will happen only in the second half of this year. We've actually given this view way back in December 23 as part of our weekly notes as well. But it is only now that those things are actually playing out. But the moment we find ourselves in a situation where the rate cuts in the US are much sharper as compared to, let's say, any expected rate cut in India, you could actually find the rupee appreciate. And to that extent, a dollar based investment, at least if that is the intention, that in a very short term you will make some quick buck on the rupee depreciation. So that is something that may not play out, being very honest. Yeah.
Understood. Understood. And thank you so much for beautifully explaining it. One next question from the audience. In your global PMS, since you're investing in ETFs, does the taxation is similar whether you're investing in international stocks or ETFs? If you can
Yeah.
touch light on that.
From what we understand is that the long-term capital gains taxation. So the taxation is, the rate of taxation is, effectively the same. So long-term will be taxed at 20% and short-term at your regular rate of taxation. But there is some contention around the period of holding, because for US stocks, it is 2 years. But for global ETFs, whether it is 2 years or 3 years is, I believe, a point of debate. What we recommend is that the investors should consult their tax consultants. In any case, as part of our process, we are not required to deduct any TDS because, let's say, for a local PMS, the PMS has to deduct TDS for NRI investors. In fact, I'll touch upon a different aspect of taxation, taking this opportunity. My apologies if this is a digression. But when we speak about the taxation of our fund, so the fund becomes taxable for, or the global PMS. Technically, it's not a fund; it is a portfolio. So the portfolio becomes taxable to a resident Indian investor because it is the global income of the investor. This is actually income. The view that we have from our investors, from our consultant, is that this is income which is not generated in India. It is global income, and hence it will be taxable for a resident Indian individual. For a non-resident individual or a foreign national, the taxation will actually depend on his or her area of domicile. So if the investor is coming in from the Middle East, maybe, then, of course, there is no tax implication. And for other regions also, their local taxes will apply. There will be no taxation in India. So, I mean, just an additional insight.
Right, right. And one last question from my side. And as wealth managers, we always advise clients to have a long-term investment horizon.
Correct.
Uh, is there any horizon that you recommend, or minimum investment horizon, to actually realize the benefit of equity markets? So is there
Right.
any horizon that you recommend for your PMS,
Yeah,
and
right.
any kind of exit load that is there on the PMS?
Sure. So in RPMS, firstly, there is no entry load or exit load. Reason for that is that because we are investing in the global ETFs, and one of the parameters that we consider is liquidity. So whenever there is any redemption, touch wood, there has been no redemption so far, but whenever there is a redemption, it will be a fairly seamless for us to actually sell those ETFs and then remit the funds back to the investor. And to that extent, there is no exit load. That's number one. As far as the investment horizon goes, so we recommend our investors to stay invested with us, for a minimum period of at least 5 to 7 years, because the kind of investment themes that we are really chasing, the high conviction names, we are really, our intention is to generate that kind of wealth over a longer period of time. In fact, I'll just again add to this. Year 2022, when we actually started our fund, it was actually the true test of our investment philosophy, because we did significantly spend a lot of time on our global portfolios as far as the backtesting process goes. But year 2022 was the true test of resilience for our portfolio, in terms of, let's say, the risk management processes that we have. And of course, how strongly we are holding on to our conviction. Why do I say so? Because in a year like 2022, some of our ETFs like semiconductors and cloud computing were some of the worst performing themes. Again, not all investors had a similar experience, because like a major chunk of them actually came in the second half of 2022. So to that extent, they were quite happy. But definitely there was a lot of panic, at least in the global markets. But we still held on to it, and that is exactly where conviction plays a role. Because last year, it is actually semiconductors and cloud computing, at least the ETFs that we chose, that gave us anywhere between 50 to 60% US dollar returns. And I'm talking about ETFs, not individual stocks. So of course, we are not very sure how the year 2024 will play out. But that is where we keep place a very key role on conviction. Like I mentioned, nothing really stops us from exiting a theme early on, but we would do it only and only if the fundamental assumptions are a bit shaky. And yeah, hope that that answers.
Yes, yes. Thank you so much, Mihir, for beautifully explaining about the gift city, about your portfolio, and answering all the questions. Yeah, I really enjoyed the discussion, and
Likewise, likewise.
audience also enjoyed this as much. And we look forward to doing such sessions with you and
No,
your.
no, absolutely. Thank you so much. Just to reintroduce the Phillip Capital group, because people would have heard of Phillip Capital in India.
Right.
But just taking a couple of minutes here.
Sure.
Phillip Capital is headquartered in Singapore, and we are we have more than 4 decades of existence, and we operate on the financial hubs of more than 15 different countries. And India has been one of the largest businesses for the group. In India, we've largely been an institutional player, so we've not been a retail player, so to speak. And because we've been very, very active on the sell side, but now we are also, spreading our footprint very fast on the asset-based businesses as well. Because Phillip Capital as a group is a very large asset manager also. As a group, we are managing more than $35 billion of assets under management across, different regions. So we've got businesses in Singapore, Hong Kong, let's say Malaysia, even Turkey for that matter. So these are very strong asset management hubs. A very reason why we are introducing this is that we've got a very strong backing of the global group when we are operating in Gift City. And that is the kind of policies and practices that we have in place for us. The institutional expertise of Phillip Capital and Phillip Capital India and the global edge of the Phillip Capital group is, what makes our existence the way it is right now. And that is how we are very, very happily serving our investors today. So yes, Aditya, thank you so much for the session. Even I really enjoyed doing this session. Really looking forward to many more such sessions, because I think the kind of questions that really came in really gives me the confidence that what we would like to communicate is actually getting communicated across. So, once again, thank you so much for the wonderful participation, everyone.
Thank you so much, Megan. Thank you.
Yes.